Welcome back, everyone, to the Deep Dive.
Great to be here.
Today, we're really getting into the engine room of a global giant, Domino's Pizza. That's ticker DPZ, of course.
Yeah, we've got their latest financials from Q3 2025, the 10Q, the press release, and we're basically going to translate all that complexity.
Right, turn it into something useful. We want to see how their big strategy, the hungry for more thing, is actually showing up in the numbers.
Exactly. We're talking sales, sure, but also store growth, how they make money across different segments, and this really significant debt restructuring they just pulled off.
Okay, so let's start with the big picture then. The third quarter ended September 7th, 2025. What's the headline?
Growth and efficiency, I'd say. Global retail sales were up 6.3%, and that's stripping out the currency effects.
6.3% globally is pretty solid.
It is, and what really jumps out for me anyway is the operational leverage. Income from operations climbed 12.2%. That's a healthy jump.
12%, wow. Okay, and they kept opening stores too.
Oh yeah, relentlessly. They added 214 net new stores in the quarter, mostly international, 185 outside the U.S.
And 29 here in the States, so still expanding everywhere.
Pretty much. It shows that global scale they're always talking about. It's systematic.
And that system, that scale, it's all supposedly guided by this hungry for more strategy. Let's break that down a bit. What are the pillars?
Okay, so the documents lay out four main things they're focused on. Think of it as their playbook.
Right.
First, most delicious food. That's where the menu innovation comes in, like that Parmesan stuffed crust we saw mentioned.
Makes sense. Keep things fresh. What's second?
Operational excellence.
Okay.
This is classic Domino's, right?
Yeah.
Speed, consistency, making it easy for the customer, all about efficiency.
Okay. Food operations.
Third is renowned value. So not just cheap, but competitive pricing, deals, personalized offers, that kind of thing.
Value.
Got it. And the last one?
Number 4 is all about the franchisees, enhanced by best-in-class franchisees, getting those local owners fired up and driving growth market by market. And that franchise model is just massive for them, isn't it? Like almost all their stores.
Yeah, something like 99% of their, 21,700 plus stores are franchised across, I think, over 90 markets now. That structure underpins everything.
Okay, so let's connect that strategy, especially the value part, to the actual sales. U.S. same-store sales growth, SSSG, came in at 5.2% for Q3. What drove that?
Well, the source material is pretty clear here. The main driver, overwhelmingly, was more people ordering. Higher customer transaction count.
More orders. And that came from?
Mostly that big promotion they ran, the best deal ever. Seems like it really worked to pull people in. Volume was key.
So the renowned value pillar in action.
Yeah.
Lots of deals bringing in traffic.
Exactly. But it wasn't only volume. There was a secondary factor. The average check size also went up a bit.
Ah, okay. And that's linked to the new menu items, like the stuffed crust.
Precisely. People came for the deal, maybe added on something a bit more premium, like the Parmesan stuffed crust. So volume from deals, a little margin help from innovation. It's a classic combo.
But that raises a question, doesn't it? If you're leaning so hard on a best deal ever to drive traffic, how sustainable is that? Does it start to chip away at the value perception or even margins over time?
That's always the balancing act in QSR, you know. For this quarter, at least, the numbers suggest the volume made up for it, and internationally. Similar story, just maybe a bit less dramatic.
What were the international numbers?
International SSSG was 1.7%, again excluding currency impacts. And guess what the main driver was?
Let me guess. More transactions.
You got it. Higher customer transaction counts. They're just focused on getting people to order one transaction at a time all over the world.
All right, so more people ordering pizza globally. Let's follow that money. Where does it actually flow within Domino's structure? This gets us to the revenue streams, and one segment really dominates.
Yeah, the supply chain segment. It's kind of the hidden giant within Domino's.
Hidden? How so?
Well, it's basically Domino's selling ingredients, dough, boxes, you name it, to their own franchisees. And it is huge. It accounted for, 60.8% of their total revenue in Q3.
Wow, over 60%. So they're making a lot of money just supplying their own network.
Exactly. It's where they control quality, consistency, and capture a significant chunk of profit.
And how did that segment do in Q3, revenue up?
Yep. Supply chain revenues increased by 7.0%.
Okay, so part of that is just more stores ordering more stuff because sales were up. But what about pricing? Costs are going up everywhere. Did they just pass that all on to the franchisees?
Well, they did increase the prices they charge stores for that basket of goods, up 3.3% in the quarter. But here's the really interesting part. Even with that price hike to franchisees, the gross margin for the supply chain segment actually increased by 0.7 percentage points.
Wait, so they charge franchisees more, but their own profit margin on those sales still went up. How does that work? Are they squeezing the franchisees?
Not necessarily squeezing. It seems like their own internal efficiency, what they call procurement productivity, improved enough to more than offset the rising costs of the food itself.
Ah, okay. So they got better deals from their suppliers or found ways to run the distribution cheaper.
That's the implication. They used their scale and efficiency to absorb some of the cost pressure rather than passing it all downstream. That's the beauty of that integrated model when it works well.
Okay, that makes sense. Now, staying in the U.S., there was a weird dip in one area. U.S. company-owned store revenues were down 7.2%. What happened there? That seems off.
It does look odd at first glance, but it was totally planned. That drop is almost entirely because they sold off a bunch of their own stores.
Sold them to franchisees.
Exactly. They refranchised 36 company-owned stores, specifically in the Maryland market, back in May. So fewer company stores means less revenue coming directly from those stores.
Right. They're shifting from running stores themselves to collecting royalties from franchisees running them. A strategic move to be more asset light.
Precisely. They're becoming even more of a pure franchisor.
So did that bet pay off immediately? Did the higher royalty income make up for the lost store revenue?
It looks like it did, yeah. Even with that revenue drop from company stores, the overall U.S. stores segment income actually went up 6.0%.
Okay, how?
Because the royalties they collect from all the franchise stores jumped 9.1%. That was driven by the sales growth we talked about, the SSSG, and having more franchise stores online, including those newly refranchised ones.
Got it. So less direct sales revenue,
Yeah.
but more high-margin royalty revenue flowing in.
Exactly. And internationally, it was a similar positive story on the income side, segment income up 7.9%, again, mostly from higher royalties and fees thanks to store growth and sales increases.
This all paints a picture of a business machine that's, well, really generating cash.
Ah.
How did that look on the cash flow statement?
Very strong. For the first 3 quarters of the year, net cash from operations was way up by over $105 million compared to last year, hitting $552.3 million total.
That's a lot of cash from just running the business day to day.
It is. And when you look at free cash flow, which is that operating cash minus what they spend on capital expenditures like building new supply centers or tech, that jumped significantly too.
How much?
Free cash flow was up 31.8% to $495.6 million for the 3 quarters. That's the real firepower they have for things like paying down debt, buying back stock, or paying dividends.
And it looks like they put that firepower to use with a major debt move right at the end of the quarter.
Yeah, they did. A big one. They completed a $1 billion debt refinancing on September 5th, basically cleaning up their debt structure.
Okay, walk us through that. $1 billion. How did they structure the new debt?
They used what's called an asset-backed securitization. Essentially, they bundled up future royalty streams and issued bonds against them. They raised the $1 billion in 2 parts.
2 parts.
Yep. $500 million in 5-year notes with a fixed rate of 4.930% and another $500 million in 7-year notes at 5.217%. Pretty good rates in the current environment, honestly.
Seems decent. And what did they do with that $1 billion plus some of their own cash?
They took the proceeds, added about $160 million of their own cash reserves, and used it to pay off older, likely more expensive or maybe more restrictive debt. Specifically, they paid back $742 million of notes from 2015 and about $403 million of notes from 2018.
So swapping out old debt for new, hopefully better term debt, and reducing the total amount outstanding slightly.
Well, they paid back more than they issued using that extra cash. So yeah, total long-term debt ended the quarter around $4.81 billion. The key benefit, though, is likely locking in those fixed rates and simplifying things.
And did it help their leverage picture, like how much debt they have relative to earnings?
It definitely did. Their main leverage ratio, which they track closely, dropped quite a bit. It went from 4.9 times earnings in the prior year down to 4.5 times at the end of Q3.
So they're growing, generating more cash, and reducing their financial risk profile simultaneously. That sounds pretty good.
Operationally and financially, yes, which makes the next point kind of jarring.
Okay, what's the catch?
Despite all this strength sales growth, operational income up, successful refinancing the company's actual bottom line net income decreased by 5.2% for the quarter.
Down 5.2%. How is that possible after everything we just discussed? That doesn't seem to add up.
I know, it sounds contradictory, but this is where you really have to dig into the details in the 10Q. It's super important to understand why it decreased.
Okay, explain.
No,
Was it some hidden operational cost? Taxes?
No, it wasn't the core pizza business at all. The entire drop, and then some, was caused by something completely separate recorded down in other expense income.
Other expense? What was it?
It was a big swing in the value of investment they hold. Specifically, an unfavorable change, meaning a loss on paper of $29.2 million related to their investment in DPC-Ltd.
DPC-, isn't that their master franchisee for China?
That's the one. So this is basically a mark-to-market accounting adjustment. The value of their stake in the China operation fluctuated downwards on paper during the quarter, and accounting rules require them to record that fluctuation, even though it's unrealized they didn't actually sell anything.
Ah, okay. So the core business, selling pizzas and supplies, was doing great, generating more operating profit, but this non-cash, non-operational accounting hit from an investment dragged the final net income number down.
Exactly. It's a really crucial distinction. The underlying operations were strong, but the volatility of this equity investment impacted the reported GAAP net income. Without that charge, net income would have shown a healthy increase.
That makes a huge difference in interpreting the results. Okay, good clarification. So core business strong, bottom line impacted by an investment write-down. What about returning cash to shareholders during Q3?
They kept that going, too. They bought back about 166,000 shares for roughly $75 million.
Still buying back stock then.
Yep, and they still have a lot of authorization left, over $500 million, actually. Plus, they declared their regular quarterly dividend of $1.74 per share, payable after the quarter ended.
Okay, so let's try to wrap this all up. If we synthesize this deep dive, what are the main takeaways?
I think you see a company where the core engine, the U.S. franchise system, the international growth, the incredibly important supply chain is really humming.
Yeah, the operational execution looks strong. They drove sales, managed margins in the supply chain pretty effectively, and grew the store count.
Right, and they successfully cleaned up their balance sheet with that big debt refinancing, improving their leverage. That's a big positive signal.
But then you have that net income dip, which we now know was due to the DPC- investment volatility, not operations.
Exactly. And the other key thing, going back to sales, is how much of that U.S. growth relied on driving transaction counts, particularly through that best deal ever promotion. The strategy's working, generating more orders, more store growth, more operating income.
Which leads nicely into our final thought for you, the listener, to ponder. Domino's clearly showed they can pull the promotional lever hard to drive traffic. We saw it with the best deal ever.
Yeah, transaction volume was key.
So thinking about their goals, operational excellence, renowned value, how sustainable is that level of promotional intensity? If you need constant, potentially margin-thinning deals to keep that transaction volume climbing, how high can it really go?
What happens to the renowned part of value if it always feels like a discount? And can innovation like stuffed crust consistently offset that pressure?
It's a fascinating question about their long-term model, something definitely worth watching as you track their performance going forward.
Absolutely. A lot to think about there. Well, thanks for joining us for this deep dive into Domino's Q3.
We appreciate you tuning in. We'll catch you next time for another deep dive.